The entire economic system is based off lending and borrowing and earning and spending. When you can understand your place in that cycle, that's the difference between generational poverty and legacy wealth. Banks and financial institutions have been one of the most coveted and protected financial secrets of the elite when it comes to wealth building in this country. I want to continue to give you more insight and context on how to navigate the banking system, as well as the top asset that banks love for you to own and borrow against, for you to start taking this information and leveraging your opportunity to build legacy wealth. I'm going to give you context on what that asset is, why it's time for that asset, and possibly most importantly, how to get your hands on that asset in this video. So before we get into that, I want to give context on who I am. My name is James Phillips. I'm a career banker, financial services professional, 13 plus years of experience in the industry. I have an active mortgage loan originator's license in my state, active life insurance license, active FINRA investments license, and I'm also small business certified. So think small business banking, cash flow, and lending. I'm helping consumers from working class to sometimes working poor, all the way up to 6, 7, and occasionally 8 figures in net worth. I'm also working with small businesses from their inception all the way up to 6, 7, and 8 figures in revenue. So you're talking to somebody who has very deep, in-depth knowledge on the banking and financial services industry as a whole, as well as develop my own personal finances from negative net worth territory, FICO scores of 515 or lower at one point in time, as well as developing a small business. I'm up in 6 figures in net worth, as well as FICO scores over 780 plus pretty much across the board. So you're getting this from somebody who's taking their own financial position from negative territory to a good position and growing, as well as somebody helping other individuals, thousands of them at this point in time, and small businesses, hundreds, maybe even thousands of them at this point in time, to elevate their financial position as well. So that having been said, that number one asset that banks love for you to own and lend against is going to be real estate. In this particular conversation, we're going to be focused on residential real estate in particular. Residential real estate is one of the most stable financial assets that you can own, even if it's a primary residence. And I know that there's a lot of hype around primary residence not being assets, but again, I'm constantly teaching on this channel how you can convert it into an asset. And I want to talk to you about how you can do that in this video today. Real estate is just one of those assets that banks know will always have some level of value, and more times than not will continue to elevate in value if purchased effectively. And when you own this asset, banks roll out the red carpet, especially if you own that asset through them. If you're securing that mortgage through that financial institution, they will offer you perks on the deposit side. Many times there'll be premium bank accounts available to you. They'll also offer you, discounts on that mortgage many times for setting it up with them. There'll be a 0.25% discount here, etc. And there's also going to be tremendous lending opportunities for you owning that asset. Sometimes that's literally the catalyst to them lending other tools to you when it comes to the lending arena, is you owning a primary mortgage. Sometimes when you're looking to get your first investment property, the lender is looking to know, do you at least own your own property first? So more importantly than anything, or at least centrally important, why is it time for residential real estate? Well, let's go to the helm of the value of residential real estate, and then we're going to go into why now residential real estate is one of the hottest commodities out there in the marketplace. And then I'm going to talk to you about down payment assistance, etc., on how you can put your underwriting together to acquire real estate in the first place, or more real estate if you already own property. When you look at the value of real estate, again, it's something that is going to always have value in this economic system. It's something that banks know more times than not could appreciate in value. They're always looking to make sure that if they're lending out money, that they have the opportunity to recoup their money back, ideally with interest. But at the minimum, they're looking to get as much of their money back that they lend out if things go bad. Residential real estate is one of those things that they know they're going to get at least a certain percentage of their money back versus lending to you on an unsecured basis. When you start to think about the tax benefits that come with owning real estate, even if it's a primary mortgage, you're allowed to write off thousands of dollars in interest a year just for owning that property and paying on that mortgage. When you start to think about the appreciation perspective, in many and most markets, real estate is going to appreciate more times than not. There's down cycles, of course, but at the end of the day, more times than not, real estate is going to appreciate. When you start to think about the fact that it's a good inflation hedge, because assets tend to increase as the velocity of money increases, as the supply of money increases, which is kind of the crux of what inflation is. It pumps more value or more of that dollar value into those particular assets, and real estate is one of the best inflation hedges that you can own. You also start to think about the possibility that there's so much flexibility with real estate. You can make money with real estate. You can lend out space in your home, whether that be renting out to other individuals, renting out garage space. You look at the marketplace we have now, you have the ability on certain platforms to literally lend out your garage space for storage to individuals. So arena, or at least, mid to small size business arena of storage is now being democratized to residential real estate, where if you have garage space, other people can store your stuff in your garage and you can get paid for it. Real estate has a ton of flexible ways to keep, maintain, and grow its value. So with that being the case, banks love when you own it and they love when you lend on it. When they love when you own it, because it also shows that you have some level of financial stability to have gotten a mortgage in the first place. The days of 2008 where, the ninja loan concept, where you didn't have to have any assets, any income verified to own real estate, has long been behind us for over a decade now. You have to have reasonable financials to own real estate now. And banks know that if you have a mortgage, that likely you have at least had or possibly have decent financials. So the era we're in right now, we need to go back in time a little bit to put context on why residential real estate has been for about a decade now and will continue to be for at least another 5 to 10 years one of the hottest assets to own. Why major corporate conglomerates are getting into the residential real estate space at scale, and why it's important for you to own residential real estate going forward if you want to capitalize on the shifts that are about to happen in our economic system. If we take it back to 2008, when we had that crash, it was based around what's called subprime lending. And what I just mentioned a little bit earlier, that was basically a scenario where a lot of people were able to get into homes that couldn't afford them. They didn't verify much on underwriting when people getting into these homes. They didn't verify income, they didn't verify assets, and people were able to acquire a lot more home than they can afford. Unfortunately, at that time frame, a lot of people also got into what was called adjustable rate mortgages, which was basically mortgages that gave you a fixed term and fixed rate for a particular window of time, think 3, 5, or 7 years. After that point, those rates would adjust to what the current market rate was at that time. So if you bought a home in 2000, 2005, 2006, whatever the case may be, and you got a 3, 5, or 7 year adjustable rate mortgage, you had that fixed rate that might have been at a certain lower level at a particular point in time. By 2007, by 2008, those mortgage rates were higher than what you borrowed them at originally. So you already weren't verified to qualify for the original interest rate and the original payment. And now that payment has 25, 50, sometimes 100% increase, depending on what your rate may have originally been to what it transitioned to in 2007 and 2008 and 2009. That led to a cascading domino effect of foreclosures. And those foreclosures literally plummeted the value of real estate. We had millions of people getting foreclosed on at one time, which literally set a cascading precedence of real estate valuations dropping overnight in that era. Since that point in time, the Federal Reserve and the government came together and decided to save the economy. We're going to print and throw a bunch of money into the economy, and we're going to lower interest rates. That system is known as quantitative easing by the Federal Reserve and by the federal government. That policy by the Federal Reserve and that policy by the federal government led to a bunch of money flowing into the economy. It saved a bunch of financial institutions, and it put a lot of money into the lending sector. What ended up happening is a lot of real estate that was still really valuable in the real world was at a massive discount from the previous poor lending behaviors and the cascading foreclosures that came from those poor behaviors and lending behaviors. And a bunch of people had money to start gobbling up that real estate and reinstating the value of it and eventually exploding the value of that real estate. If you bought real estate from 2008, 2009, residential real estate in a moderately decent market and held on to it long enough, you've made a ton of money in real estate. It was hard to miss. The entire economic cycle was on fire. You could have owned stocks, you could have owned real estate, you could have owned certain businesses. It was hard to miss from 2009, 2010 up until COVID. So when you look at residential real estate, massive appreciation. You had a lot of gentrification in a lot of metro areas across the United States, where areas that were typically that had inhabitants of the impoverished or the working class, had a lot of people who were, middle class and affluent, buying up those properties, renovating them, turning them into, properties that may have been gone for 50, 60, 80, 100, $120,000, renovating them and moving into them and turning into $300,000, $400,000, and $600,000 properties. I'm in New Orleans, Louisiana, one of the most prominent markets, because we had Hurricane Katrina and 2008 within a few years that wiped out a lot of neighborhoods and opened up a lot of opportunities for residential real estate. You may be in a similar market as well. Drop a comments down below if you are in an area that experienced a lot of gentrification. So With that happening, that means from 2008 or 2009, all the way up until 2020 when we experienced COVID, real estate was a massive run-up. And the economic policies that were in place around that time made sure that that was the case, because we ended up having cheap money at high volumes. And most of that money, or at least large swaths of that money, pumped into real estate. So to fast forward to 2020, we experienced a worldwide pandemic. Many of us knew as COVID. That led to a massive shift in federal government policies and the Federal Reserve's policies. And this again was a hyper stimulus for real estate. What ended up happening in that scenario is the economic system was shut down from the pandemic. That in turn led to the federal government and the Federal Reserve decide we need to stimulate the economy yet again. And how did I say they needed to stimulate the economy previously? Pumping a bunch of money into the system and lowering interest rates even further. This time near zero, which is something unprecedented we've never seen in the economic system in this country. With that being the case, money was in cheap supply, which means lending boomed. And if lending boomed, that means borrowing was stimulated and borrowing boomed. And that led to a lot of people affording real estate that may not have been able to afford it prior to COVID, because interest rates were even cheaper versus a 5 or 4% mortgage, which would have been one payment. Those mortgage rates were down 4, 3.5%, under 3%, 2.75, meaning that you were able to effectively qualify for tens of thousands, in some cases, hundreds of thousands of dollars and more home, literally from your mortgage payment, because interest rates were sliced by a third, sometimes even in half from what they would have normally been. So that led to another boom in real estate. So if you look at real estate prices from late 2021, 2022 to where we currently are, it's record values in residential real estate in particular. All of that context having been said and put in place, it's not over yet. Interest rates were raised again in 2022 because inflation finally became a real reality in the eyes of the government and the Federal Reserve. They fought against it for a long time. They tried to act like it wasn't happening, but it was basic economics, basic supply and demand, basic velocity and flow of money. There was too much in the system, and it was pumping in the assets at a rate that was inflating them, that was unsustainable. So now the Federal Reserve and the government came together and said, we need to do what's called quantitative tightening, which is the tightening of the money supply, the raising of interest rates, which pulls money out of the system. And it also reduced the lending capacity of financial institutions and private markets. And that led to the slowing down of money flowing in the system and the inflation of assets. What's crazy about it is real estate in most markets, with some exceptions, really never slowed down that much. Real estate is still, to this day, at the time of this recording, still appreciating, even with all of the downward pressure from interest rates and the slowing of money and the slowing of borrowing and the tightening of banks since this economic system has rolled out since COVID and the interest rate hikes in 2022. Banks have gotten significantly tighter at lending on all levels. That still hasn't slowed down the appreciation of real estate. One of the reasons being the next catalyst, an inventory shortage. There's not enough homes on a marketplace for the amount of people who want to buy them. That is a cascading effect from the 2008-2009 era, where a lot of construction in residential markets slowed down. We didn't build the way we needed to build 10 years ago, and it's kicking us in our behind now in the 2020s. And so on top of the fact that there's a ton of money in the system, rates at the cheapest that they've been, now we have an inventory shortage. And again, this is basic 101 economics, supply and demand. There's more people with the ability to buy real estate that want to buy real estate that can't. And because there's not enough homes. And so the people who own homes don't want to sell them because they don't want to go to double the mortgage rates that they got from the previous economic cycle, where they were able to get a 2.7, 3.5, or 3.75% mortgage rate. And now they're 6, 7, and sometimes 8%, depending on your financial qualifications. So many people don't want to sell. We have a physical housing shortage of millions of homes. And there's a ton of people who are in position to buy that are bidding on homes, that are competing more for homes. This is jacking up the value of homes. Now where we are, if you're keeping up with this, is a situation where we're still having an inventory shortage that's going to take years to work itself out, and rates are on their way back down. I'm going to shoot a totally separate video about the economic cycle we're about to go into, but it's about to put the spotlight back on residential real estate again. So that having been said, now that you have context, and hopefully you understand why real estate is one of the greatest places for you to be now and in the next 5, 7, or 10 years, I want to teach you and talk to you about how you can qualify for it. So I have an active mortgage loans originator's license. You can go into the description section or go into the about section if you want to look into my license, etc. But the NMLS number is 771386. So I'm going to talk to you about the programs available. We're going to talk about down payment assistance in particular and other things that are going to help you qualify for real estate in the first place or more real estate if you're looking to invest in it or at least get a second home. Because in many cases, in many markets, real estate is about to likely experience another rise up. It may not be as high as it was in 2021 or 2022, but to say that it never slowed down with interest rates the highest they've been for 20 plus, 30 plus years, that means when they start to come down at all, people are going to fall off of it. They're literally going to fall into the marketplace trying to buy real estate, and it's going to lead to a competitive market that's going to bid prices back up because more people will be able to qualify for the payment. First thing you're going to need to have in place just to get the fundamentals out of the way, good, stable, strong income. 2 years worth of it in most cases if you're looking to buy primary residences or secondary homes. If you're looking to invest in real estate, we're going to get into that on the back end half because that's a totally different beast. But if you're looking to qualify for primary or secondary real estate as a second home or a vacation property, you need to have 2 years of qualified income if you want to get it from a mainstream financial institution. And you ideally need to have a good work history to go along with it. You need to be in the same industry for 2 years or more. If you've changed industries, I don't advise you to go from W-2 to 1099. That's from a stable income source to a harder income source to verify. And you need to have that 1099 for 2 years. So if I've caught you early enough, don't switch from W-2 to 1099. It's not a good idea if you're in the process of trying to buy a home. You need to qualify for 2 years. In the same industry, ideally W-2 is best. If you're in a 1099, you need 2 years of tax returns and whatever other bank statements to qualify that. The next thing, you need to have a credit score of at least 580 to 620 to get your foot in the door. If you want the best rates available, think 740, 760 and north to get the best rates on mortgages. 760 is really more that threshold. The next, and that's a middle FICO score out of your 3 FICO scores for those of you who may be a little bit newer to this. The next thing you're gonna wanna have in place is you're gonna wanna make sure when you're shopping for the property, you check out the escrow. Are you in a market like I'm in New Orleans, Louisiana? Insurance and taxes are through the roof in my market in the metro area. And so that's a really big component. A lot of people's escrow is bad as their principal and interest. So check your market before you get in because you want to make sure that you're not buying somewhere where it's like, oh, my principal and interest qualifications are great. But then they go to do insurance and taxes and they find out that you qualify for half of it because it's literally as much as your P&I. So do your due diligence on your escrow in advance. The next thing you're going to want to check on is stuff like down payment assistance. Thankfully, because real estate is such an attractive asset to lend against, there are a ton of zero down options. And we're going to talk about that from the bank side. And then we're going to talk about that from the local, state, and federal side as far as grants and other programs available, okay? So when you start talking about it from the bank side, banks are going to offer you zero down to 3 to 3.5% as kind of the foundational low down payment options. Think USDA, VA, and some conventional programs nowadays where you can qualify for 0%, 1%, 2%, or 3% down on mortgage loans. Then again, it's going to be USDA, VA, or some conventional. Check local institutions or the banking institution you bank with for those zero down opportunities. If not zero down on conventional, at least it's going to be available as 3% down with some kind of grant program within that banking institution to help mitigate, your closing costs or even help you buy down on your rate. So 3%, 3.5% kicks in at the FHA level. That's going to be a totally different lending program, but that's going to be a scenario where at 3.5% down, whatever the property price or the sales price that you're looking to get in on, that's going to be 3.5% down, usually qualifies for closing cost assistance. And there's going to also be the opportunity for you to potentially buy down your rate, et cetera, with FHA. The only thing with FHA is you usually can't get rid of the mortgage insurance that you have to have with FHA. So keep that in mind. That can affect your qualifications when it comes to your debt ratio and your monthly payment because it may be $100, $50, $80, $100, $150, and that can fluctuate your overall qualification of how much home you qualify for, believe it or not. With conventional, there's an opportunity for you to get rid of the mortgage insurance somewhere down the line based on the equity of that property down the line. I'm not going to get in the weeds on that right now, but it's something for you to do your homework on. Beyond that, you can think anything from 5% to 20%, 25% down. The reason that a higher down payment can be beneficial is you can completely circumvent mortgage insurance. The lender's going to potentially give you better rates and terms on that because there's, again, more skin in the game from you and less risk for them because they're going into closing this deal with 15, 20, 25% equity space. So if you collapse on that mortgage shortly thereafter, especially if it's a property that has good appreciation potential, the bank can know that they're going to get a lot of their money back, if not all of it. The next component that is important is, if you're not going to put a lot of money down, do you want to buy a property that may have some equity already built into it? And this is a possibility. I bought my primary mortgage personally from an individual where we had a hurricane a few years back. That person went to put their property back together and they renovated it from top to bottom, but they were in a hardship position. They were in a short sale type of position. And basically what that is where they were no longer able to afford the payment and they were trying to sell it at a discount, and the lender was now the one leading the sell of that property. There's other terminology for it that's not, I'm drawing a blank on, and if it pops in my mind, I'll throw it out there. But think short sale opportunity where that person's distressed, they still renovated the property. So there was an equity spread versus what it was being sold for, because it was being fire sold. They needed to sell it as soon as possible because that person was already behind on payments. So there was insurance money from the damage of the property from the hurricane that hit the local area, and that person needed to sell it at a discount. So I was able to get in with a 5-figure equity position because that person needed to sell their property as soon as possible, but the property was in pristine shape. Look for those type of opportunities, because if there's equity on the table, I didn't have to put much money down. I still got access to a grant because where I bought it at, that bank was incentivizing individuals to buy. And I was in a good subdivision, by the way. I'm not, in the hood or in some kind of dangerous area. I'm in a really good subdivision that has an HOA, etc. So I just want you to know those opportunities exist. Look for those distressed buyers. They do exist. And the property doesn't have to be beat up for you to take advantage of that. But the moral of my story is, if there's equity in that property beyond what you're purchasing it for, this is further incentivizing the lender to lend on it and to even give you better rates and terms and incentives around that property. The local, state, and government opportunities are abundant. A lot of COVID money went into first-time home buyers and overall home ownership initiatives. There's a lot of money from banks with grants and opportunities, incentives, and there's a lot of incentives from local and state and federal level opportunities to buy properties and get $3, $5, $7, $10, $20,000 in down payment assistance or more that can be combined with your bank. A lot of opportunity for you not to have to put a lot of money down on a property, because there's a lot of local, state, and federal money on top of the bank's incentives to get in on that property. So this still reduces the risk for the lender, making them have an appetite to lend on it, and it keeps money in your pocket or keeps you from having to come up with a ton of down payment money. By the way, for down payments, that money needs to be verifiable in most months, 3 months of seasoning. It needs to be in whatever bank account for usually about 3 months or so. You have to prove it with bank statements. If it's a gift, you have to have a letter. There's a whole process if that money's coming from somebody else who's lending or gifting you the money, ideally, to get into that property. Just wanted to throw that out as an additional caveat for those of you who haven't bought a home before and may not know. Let's go to secondary properties. So when we talk about second properties, second homes, and vacation homes, down payment requirements are higher. Think the threshold of no lower than usually 10%, 15% or higher on down payments. Secondary homes and vacation properties can be great assets. They're lifestyle assets where you get opportunity to own property somewhere else that's either more convenient for you, or an opportunity for you to build legacy through vacations with your family and family reunions there, and etc. But there's still good opportunities for appreciation, because you could be buying this property somewhere where it's appreciating, writing off the mortgage interest still, and it's not that bad of a down payment threshold of 10 to 15% on average. So keep in mind, a secondary property typically has to be somewhere that is justifiable for an underwriter to underwrite in. You can't buy a secondary home as like a second primary mortgage in the same vicinity where your existing home, your primary mortgage exists. It has to be somewhere more convenient for work, miles apart, hour or two out, or a vacation property in a different climate. So you bought a beach property, a ski resort property, a property in the desert somewhere. You had to buy a property that makes sense to underwrite at that lower threshold of 10 or 15% down. For investors, if you want to get into investment properties, this can range significantly because it's a wild, wild west on underwriting and lending in that space. Mainstream financial institutions are going to be looking for 20 to 25% down. There are a lot more leery on investment properties because you don't have as much skin in the game typically because you don't live there. So it's more of a speculative function from you. And so banks know that if you get in a financial crunch, you're much more likely to stop paying on that investment property than your primary mortgage. So very important for you to understand that if you're looking to invest in real estate through your average everyday bank, they're not going to have nearly any down payment programs. They're going to want higher down payments and higher requirements for you to qualify for that loan on that investment property. If you want to get into private mortgages and hard money lending, That's a scenario where you can potentially go in with no money down if the property has enough equity in it, or if there is an opportunity to work out some kind of like seller financing opportunity with the seller of the property, or you can get that access to capital from another source. Hard money and private lenders will lend on 0% on investment properties. The criteria on the other end of that is that property has to have great equity and after repair value opportunities. There has to be an equity spread. There's always a risk mitigation factor. So if it's not going to be your down payment, you have to be a great borrower, good credit, good income, and that property has to have great equity from some other means. The seller is helping you with that. The property has great after repair value, and they're getting the lender is getting in on that. Has to be an opportunity. You can get very creative with investment properties, but it depends on who you're going to try to borrow that money from and their criteria. The bank is not going to want to hear all of that. A regular mainstream brick and mortar financial institution is going to want 20 to 25% down on a structurally sound property that can pass an inspection. So usually they're going to be your takeout lender because they're going to often have better rates than your hard money and private lenders are going to have that might let you get in on that property with a lot more flexibility, but they're going to be looking to make a better profit on their property. So you use a hard money lender or a private lender to get in with little to no money down, fix the property up, create that value in the property, and then turn around and refinance into a mainstream financial institution that's like, okay, this property is pristine, passes on, it has a tenant in it already, and passes all our other markets. You are a qualified borrower, you have decent credit, decent income, verifiable income, and the equity is already in the property. So now we're willing to take over this property and give you a much better rate on this property, longer term financing. Much more I can go into on this topic. This video has gotten long enough. Hopefully most of you are smart enough and value the opportunity to get all this information for yourself so you can scale into what is legacy wealth that many have been playing at the elite level for generations. Our turn is finally here for us to get in on this same game, and the economic system is about to shift after this election cycle and after these interest rates start to drop. Comment down below. This has been a long, detailed video. Questions, your experience with real estate, your experience with how banks treat you when you own real estate, your experience with qualifying for it, making money from real estate. Do you own a primary vacation home or investment property? Comment down below and let me know what your relationship is. Owning real estate and its value is created for you in a legacy component. Comment down below. Other than that, I want you to continue to support this channel so this channel can continue to support you. Like, comment, share, subscribe. That is an easy, free way for you to continue to support this channel so this channel can keep supporting you. To all my pioneers, welcome back. To my new viewers, welcome in. I'm appreciative for every single one of you. I want each of you to stay focused, stay in motion. I'll see y'all soon.